Futures and options on futures trading involve substantial risk and is not a suitable investment for all types of investors. Past results are not necessarily indicative of future results. When I use the word I in this video, it refers to what I teach in my charting course or what I author in my twice daily oral and written updates. Prices shown on charts and quote boards are in real time and take into account all known activity up to this point in time. And if you'd like to read more of this disclaimer, simply hit the pause key on your video player. Good afternoon, all. Ira Epstein of Linn & Associates with your metals market update for this Tuesday, the 16th of May, 2017. We're getting on to 2:10 p.m. Central Daylight Time. You know, I read the comments that you all write to each other and leave for me. I can't respond to all of them because some people ask specific questions in the government. The disclaimer I have to put on everything is longer than what I can write. I know it sounds crazy, but this is all part of the Dodd-Frank. So please understand, I love the comments, good and bad. I read them. One of the comments yesterday was, obviously, Ira, you're a gold bug, and I've got to share this with you. I'm anything but a gold bug. I'm just a bug. It's not about gold. It's not about silver. I'm an analyst. And what I do is I look at the charts to see the action. And one of the things that I love is that when I teach, and I love to teach, I mean, if I weren't a broker, I'd love to be a teacher of this. I removed the name on the chart because I've learned over the years that if you see it's gold, you get swayed. Oh, I don't like gold. It's got to be going down. I love gold in this environment. How could you not own it? It's going up. Take the name off and judge the chart. You're going to find that you think differently about it if you can twist your mind to do such. So it's not that I'm a gold bug or non-bug. I'm just looking at the market. And what I looked at recently was this. I was expecting when the market got up here on the weekly charts that if it failed, the momentum would carry back to the 18-week moving average of closes, which is in red. Under it in the green is the 100-week moving average of closes. If the market gets under here, I get and say, bulls have no chance, this market's in real trouble. As long as that didn't occur, I was looking for a pattern on the pullback that could ultimately result in the market trying to set up a bullish pattern. That doesn't mean it'll follow through from there. This was the zone I had picked for a number of reasons I do it, and it's all in my charting course, and it fit right in. So the battleground right now is the 18-week moving average of closes. You have the swing line with higher lows. You've had higher highs. Battleground right here, lower support 1209. If that gives ground, at least the 1185.90 is your next target. When I take a look at the thrusts in the market, the overall thrust had been down. Now, if you come up enough and you get a correction and start back up, I'd get friendly and say the thrust is up. I looked at each one of these closes, and right here where you get this little part, it really did have about a 50-cent higher close on the daily chart before plunging down. One part of me says, okay, you can call that an upthrust. The other part says, nah. Since I don't use this in my real definition of trading, I just do it so that you can see how the market's swinging. I don't have to bother with it. What I do use for my analysis when I'm telling my clients what to do are the daily bar charts, obviously, and I do look at weeklies as well. And then I look at this swing line because you can't get away from it. It's either there or it's not, and it's got higher lows and higher highs on the daily chart. That's bullish, unless you take out 1216.90. The market held the 100-day, this is the difference, remember it's a daily chart, moving average of closes. Did it really? Well, you'll often hear me say the first challenge is if you slide through it, come back, and the market tries to make a move back over it. Sometimes it's just that move, and it can move away from it. The first time is the problem. And then you can see what you get. Doesn't mean you're not going back under it later. So don't think that once you hit it, you don't hit it again. But this is what I often expect. I expected it back here, so why would I think any different right through here? So now what I'm looking at is if the market can extend the rally, 1246.10 is a good possibility. And if the market were to zoom from there to the upside, 1257.30, the 200-day moving average, which this was the first time in folks, go back on your charts. A long period of time. Gold has not been over that 200-day average. You got to go back to when it was $1,900 an ounce and you started watching the markets fall. And you'll see what I'm getting at. In terms of Bollinger Bands, you've moved away from them. They're really not in play at this point in time. What's in play is momentum off the slow stochastics. Now, the slow stochastic oscillator is made up of two lines that crisscross each other. I give them values. They're called the K line, which is the red, which moves around the blue line. The blue line has less active days in it than the K line. The K line uses 3 days in its formula, the blue line 5. Therefore, one's a shorter term average than the other, and it'll whip around it. Right now, the market is pointing with upside momentum, which could carry it to that 18-day average of closes. Doesn't have to, but that's a potential area. Another thing favoring these markets right now is silver got beaten up by this market, and now it's coming alive, and you're getting a good-sized correction. I don't know where it's going to be today. 73.62 is the real number, so forget that 73.98. That was from yesterday. It's slipping down at this point. I don't have the settlements. I was outside of my... I enjoyed Chicago. It was in the 80s outside for a change. In the gold ETF, you've turned the momentum up. Same thing as the futures. You held better the 100-day moving average of closes, and much closer together are the 200 and the 18-day average of closes. Now, the negative on this was that this market did have a bearish crossover. The 18 got under the 200. That is not what bull markets are made up of. So a bit of a problem on the market there. The GDX, gold miners, this market has a pattern of higher lows, higher highs. It's fighting a battle right here. That's why I left this arrow. I want you to see it. Hit the 100-day average yesterday. It's doing it again. You could have two arrows here, very easy. But you're overbought. So I'm concerned that this market's going to have a lot of problems if it gets up to that 2292 area. Given that this led the parade to the upside, I'm not saying it has to fall apart, but it's going to signal when it corrects that maybe the laggard's going to be the futures right behind it. In the silver market, you finally got back to the 18-day average. Now, let me show you the theory. When you lose an embedded reading, my theory, I've never seen this anywhere else, is that the market is going to make a run at the nearest of the major moving averages. And on this chart, it's the 18-day in this case. There's the 100, so they're further away, the other averages. Bingo, you got there today. Like a pinball machine that you shake too much and you got to hit a reset button, that's the reset switch. It was just hit. That does not mean the market has to go any further. It doesn't mean it has to go down. It's now in its home area. And notice how the market stopped there. I noticed this phenomena years ago when these things occurred. You can see them here when you were embedded and how the market started slipping and you went back to that 18-day average there. So markets like to have a neutral zone, and discovering it is what's important. And we're at a neutral zone on it. When I look at the SLV, won't take very much to hit it. You lost your embedded reading. I'm saying 1602 from today's high. That was 4 cents away, so you're certainly making the attempt at getting up to there right now. The copper market's interesting. It's got upside momentum, a slowdown in China, the swing line is up, and frankly, if this market takes out 255.70, you might see a string of buying as traders try to kick it up into the 263s again. Should be very interesting. If it gets up there and then slips back, unfortunately, under today's low, that can be the negative. So you can't get away from $700, $800 risks in this market, which is not my cup of tea. In the platinum market, as you can see, yesterday you got to the 18-day average, and the market is still moving up. And this all occurred when you lost the embedded reading. It started the market back to that number. Can it get up here? Who knows? But right now, momentum's up, the trend is up, the bias is up. This market's in a solid uptrend right now, whereas the palladium market slipped down today and challenging the lower Bollinger Band in an oversold condition and loss of upside momentum. Still oversold, but still downside momentum in the market. Then we get to the dollar index. All right, you would have thought that with the Fed FOMC meeting coming up in June, this market would be stronger. What if I told you that the trade surplus in Europe today came out and it was the highest ever for the month of March against the dollar? And that's since the currency, I think the currency first came into being around 1999. Strongest. So President Trump's idea, he wanted a lower dollar, he's getting it. You'll hear all these people talk about dollar strength against the basket of currencies, which is how the index is done. This market is breaking down. It is not in an uptrend, contrary to what you hear. It is getting into oversold territory, and it's not trending. It's got a higher high and a lower low, but it's certainly not in an uptrend. And that's part of what you have to understand. The press says one thing, as we hear so often, and then the reality is maybe they don't know what they're talking about because they're not looking at the charts. We find out. Tell you something I like to do. You ever hear of consensus? Try to imagine maybe 100 different newsletters coming out of different trading companies go to this firm, maybe more than that. And they'll write on the metals, they might write on the interest rates, the stock indices. They compile them all, looking to see if they're bullish or bearish, and they create their bullish index. Think of it as like a relative strength index that you can work with coming from all these different letters. Then the neat part is with your 4-week free trial, you get an email and a password from them, and you can go in and read all these letters. It's all online. It's easy to do. I used to get this sent to me by mail. By the time the mail got here, it wasn't that good. Now it's phenomenal because it's right online. They want to offer you a free 4-week trial. Take advantage of it. What do you got to lose? You get to see what other people do, how this works. And every Tuesday, that consensus comes out. It'll look like this. It'll show you what the market is doing. It'll plot how it's been doing in the past. Call us. Go to our website. If you go to the website, you'll see a carousel of free offers. You can click right up here. You'll see an icon from YouTube. Click on it. Our form will appear. Or underneath us on other websites, it says, click here for Ira's free information. Do such and fill out the form. Away you go. We'll get you their password, their user ID from them, and you'll be set. I'm Ira Epstein. You have yourselves a great day, and thanks for watching. I'll see you tomorrow.